Hello and welcome back into the Map Room for another one of our Map Room briefings. And today we're going to talk about specifically the role of venture capital. So along with what you may be aware of, the kind of angel seed type money, and often we've spoke about before on the podcast, the role of PE, and there is a perception there that maybe that's often aimed at the larger organizations. So today we're going to talk specifically, as I said, about the role of venture capital. And that brings me on to our subject matter expert for today. I'm delighted that we have joining us in the Map Room, Ben Davies. And Ben is from Praetura Ventures and is hopefully going to educate us to all things about VC. So hello, Ben, how are you?
Yeah, good. How are you, Stuart?
Great. Okay. So I suppose we should start with a very simple question, or it might be the $64 million question. What is the role of VC funding?
So VC funding is largely for growth, right? What we're trying to do is invest in exceptional founders building great businesses that will deliver outsized returns, right? VC inherently is a risky game, as in we are investing in a period where there's perhaps less traction, less to analyze compared to sort of a much larger check coming from something like private equity. Venture capital also varies wildly based on where you are. So there are certain VC ecosystems that are very, very well developed. The classic is the West Coast of California or New York. Likewise, London and the Southeast, they call it the Golden Triangle between sort of London, Cambridge and Oxford, is a very active area for venture capital. Whereas where we're based in the northwest of England and across the north of England, it's still a fairly nascent ecosystem. Like Manchester is a big media marketing tech city, but that really has only just happened over the last sort of decade, I'd say, or at least since the BBC moved here and the city's seen really strong growth. But at its core, what a VC is trying to do is see an opportunity that can deliver a significant return. And when I say outsized returns, I'm saying, in a fund of 10 businesses, you'll see a handful fail, a handful probably return between 1 and 2x, and then 1 or 2 basically return the entire fund. So that might be 5 to 10 to even more times the money that's been invested in it. Across that fund, each one of those 10, at the point of investing, we have to believe that
Has a chance.
Deliver that, if that makes sense. So for your client base, I think what's important here is just because a business can't attract VC funding doesn't mean it's not a great business. Likewise, what we tend to see, particularly with people, say, from an agency background, it tends to be a service-based model. More clients, more people, more outputs, some recurring revenue, but often it tends to be project based. 1-to-1, that scale is difficult to upscale without adding loads of heads on top of it. Where we've seen agencies do really interesting things is where they have a consistent problem, or their clients ask them over something, or maybe it's an issue that they face, and they productize it. So they design something that is one-to-many, unlimitedly scalable, very quick to be able to be taken up by other people. And you'll see a lot of agencies, when it comes to VC capital, agencies tend not to be able to attract VC investment. But when they flip into a product, that product, when given the right amount of potential, can scale out. And then you might find that how we look to exit. So is through a trade sale or an acquisition, or a much larger funder will come on later than us and maybe buy us out. So to your point about some of your client base in terms of partial exit, early stage VC won't give you any money back out of your share capital, right? You are basically raising, say, an investment round of £2 million at a £10 million valuation. And our hope and your hope is that all of that money goes into growing the business, and that valuation will be increased significantly in, say, a few years' time, where a Series B, Series C funder may come in, may give us some money back, give you some money off the table. They will never give it all off the table because they want to keep you hungry. And then it might be that the eventual exit is to a private equity firm who will buy the whole lot for a set amount or a trade sale. But even then, you don't get all your money out on day one. There'll be a payout period, if you like, or an earn-out period, where you get half on day one and the other half is based on the business consistently delivering over the next X years. Something to be aware of that, because quite often people don't see the second half of that money.
Absolutely.
But it's don't set the bar so high when you're trying to sell the business that you're never going to see the other half of it anyway, but that's quite common. But yeah, I think that's for VCs at the early stage, which is what we are. So that's all the way from something called pre-seed up to seed, up to series A, B, C. There's loads of jargon in this sector. So all that basically means there's different size of rounds and how you kind of group them together, and different things are expected from you at different rounds, basically. Quite commonly when people come for funding, they're talking about things that a Series C business might talk about, but actually they're seed stage money. And actually it can show the perhaps inexperience of the founder to be talking about things that are much later to them when they're actually asking for money that will never be able to achieve that. And actually, when you're in that funding journey, the goal here is actually just to get to the next stage sometimes or deliver on your strategic plan, not say, I'm going to get 100K off you and I'm going to take over the world, because the reality is you won't.
Yeah.
Unfortunately, it's often a bit of a crash landing for founders. What we tend to find is they're sector experts, they're not investment experts.
Totally.
And there's a lot of conflicting advice out there as well. Definitely some better than others. And actually, it's about seeing your peer group, connecting to other people, scanning the market and getting to grips with this. Because I think if you're, building a decent tech product, kind of, to be honest, in the current market, unless you're immediately profitable or you can make that work, you're pretty much always going to be fundraising.
Yeah. I think we'll come back to a few things you've said there, Ben, but I think the bit that interests me specifically is as you say, and with respect to all the founders, I'm going to use the word ignorance on this, the ignorance of what is available and what their business might look like to a potential investor, is that there tends to be, the reason I asked the question about is exit binary, it is in this sector, there's lots of people who believe there's one bite of the cherry, there's one sale, and they don't often understand that, potentially where, in my experience, a VC can come in and help you is recognize, first of all, whether your business is on the right trajectory. So is this business something that can become something bigger and better in a number of years' time? And we've seen, particularly coming out of the COVID pandemic, a number of agencies who've developed those products, sometimes to solve their own problem internally. Sometimes it was, we need to change the way we manage our projects, the way we need to manage things remotely, whatever the situation is, and haven't understood that they've potentially got a product, potentially got some IP that, as you said, they could scale. But they seem to have a belief that, and as you say, there's lots of advisors out there, be it accountants like MAP, that will tell people this is a 3-year journey, you've got to get to a certain size, a certain scale, when actually sometimes getting involved in a relationship with a VC or someone like yourselves can say, well, actually, yeah, it might cost you some equity today, but this team of people might do one or two things. They may accelerate your growth, might take you in a different direction, first of all, take you in a direction you didn't know existed, might accelerate your growth, or just might get you into a market that you have no presence or understanding. So I think that's something that lots of people don't recognize. A VC, as you say, maybe the mix. It may not be the VC starts and ends, that the VC will end their relationship, but your investment journey, as you say, may go somewhere else, may go to PE. Because particularly when we've had PE people in the MAP room, they say the right thing, but they'll explain that it needs to be £1.5 million EBIT before they'll even look at it. And I often say, well, there's other routes that you can get into there to do something. You mentioned also maybe the stage at which you come in, and you said sometimes it's difficult to know, and you're taking a let's just say a mixed risk to go, okay, here's 10 ideas, 10 entities, and we think they could all do something, and we need one or two of them to do really, really well. You say about the experience of the founders. What do founders look for in your experience when it comes to investment? But more importantly, what are they missing?
So that's a great question. This thing works two ways as well, right? Like, getting bad money out of your business is very difficult, right? So you are interviewing them as much as they are interviewing you, but I'll come on to that in a minute. In terms of being able to engage with VCs, we are super transparent. Everything's on our website, exactly what we look for. We have a 6M's model that goes through, model, management, momentum, all these different things that we directly look for. It obviously depends on where you are at the stage. If you're a pre-seed business, you might have an MVP. You might have sector expertise, but it's largely we're betting on the management team, right? Do we think these people are capable of growing something meaningful? Perhaps then at seed or Series A stage, you've kind of got a small team together. The majority of your tech's built. You've probably got some early traction. You've got some early clients. You've had founder market fit. You're now going to start to try and find a bit of product market fit. At that stage, there's more to analyze. So we'll be looking at your numbers. So key things like annual recurring revenue, churn, what's your burn rate? Because at the moment, there's actually less money around than there once was. So actually, people don't want to inherit something that's going to be costly and going to need to fundraise very, very regularly, because it's quite common for an investor to do follow-on funding. But obviously, once we've got a stake in it, we have a propensity to want to follow on with it. But that comes with a challenge. We have 60 portfolio companies, often all of which who need some follow-on funding. The best thing you can do is get a data room together, right? Because there is nothing slicker. Post-pitch, you're both really excited. Everyone's in a good mood. Can you just send us that detail for us to analyze it? And it takes 12 weeks, right? Delays kill deals, right? Time kills deals. The easier you can go, everything you need is well organized, all up to date, all sourced in this data room, plonk a link to them. It just makes life so much easier, because internally how this works is, so you'll apply online to us anyway. Lots of VCs have different structures, but for us, everyone goes through one form. You then have a call if you fit within the mandate or it sounds interesting. That individual investment exec or manager then has to sell you internally at investment committees, right? So as soon as you've got them, the critical thing is for them to become a champion for you internally, right? That energy that you give to them needs to be infectious so that they pass that on internally and they're super excited about it and they're willing to put in the extra time to get you through investment committee compared to the other deals that they've got on, right? So some basic metrics. Obviously, as I said, ARR, churn rate, burn rate, the things that sort of show that you're across the numbers, any key metrics that you can see as well. We'll also look at things like cohort analysis, who joined when and when did they, and some of that data, particularly in really early stage businesses, isn't very well analyzed.
Yeah.
I'd encourage you, this whole process becomes so much easier if you kind of get your house in order before you engage in it. However, the thing that I think people get wrong a lot is, I speak to founders all day, every day. We've spoke to founders go, oh, nightmare fundraising. I can't get any blah, 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 blah. So how many investors have you spoke to? 10. We haven't even started. Treat it like a sales process. Treat them like sales prospects. We had a great bit of advice from one of our best founders who once said to us, he was like, best raises the most money out of anyone that we've ever met anyway, in terms of the portfolio. But he listed the 200 investors he wanted, right? And he prioritized them in the ones he really wanted and the ones he wanted the least. And he started with the least, and he pitched and he pitched and he pitched and he took on feedback and he pitched and he pitched and he pitched, and he refined to the tune where he was getting better and better and better. He got to the ones he wanted more and more and more. He dealt with all the objective responses. He dealt with all the questions, and actually he'd also picked up a couple of offers along the way, right? So he created a bit of competitive tension as he got further up that list. And I think that that's something to really take note of, is treat this like a sales pipeline where you've got top of funnel that are going further down to decision stage. I'd also encourage you, what founders get wrong is, they say, I want to fundraise in 3 months and I'm cash out in 3 months. Start a year in advance, right? Because there's nothing more impressive than when a founder comes to a VC and goes, in a year's time, we're going to do X, Y, and Z. And then in a year, they come back and say, we did all those things that we said we were going to do. Everyone will say that they're going to take over the world in the pitch deck. Everyone says it. Everyone has a hockey stick graph, right?
Yeah.
It's so much more valuable if you've demonstrated that you can do it. And what I'd encourage you to do is be speaking to people, maybe a fundraising round ahead of you. Say, for example, like we work very closely with a business called YFM, who are in Manchester, who fund checks a little bit larger than us. Speak to them a year out, a couple of years out maybe, because I guarantee when it's person ringing person, Ben ringing Stuart, it's so much better than Praetura ringing Map, right?
Yeah.
So that's something to be said anyway. And different VCs will have different processes, but largely, a data room, a pitch deck, the usual stuff you would expect. When it comes to founders doing their DD, on investors. If it's too good to be true, it normally is, right? I would encourage you to go and speak to their portfolio companies, and not ones that they put forward for the case studies, the ones that failed, right? When stuff didn't go wrong, what were they
Yeah.
like? That's
Yeah.
more important, actually.
Yeah.
Look at their peer group. Is their portfolio a peer group that you think are going to challenge you, drive you forward, share the best things? Is that a group you want to be part of? Likewise, every VC sell when they want to invest in you at term sheet level will help you grow your company. If they can't point to a structure that helps them do that, and there's 3 of them, and there's 50 portfolio companies, and they haven't got any mentors in tow or a program or anything like that, the reality of it is they probably don't help you grow your company, right? So at the really early stage, it's about pulling together partners who can actually help you do something exceptional, who are going to roll their sleeves up, put skin in the game, who've been there before.
Yeah.
It's essential as well, because
Yeah. Agree.
if you look at some of our larger portfolio companies, we've just recently launched an education platform for founders that's free called the Founder Hub. And we were interviewing some of our later stage portfolio founders to give advice and this and that. Anish from Access Pay says, I wish I'd not listened, not us, by the way, I wish I'd not listened to some of my earlier stage investors, because actually none of them have ever done it before. And none of them knew my business better than I did.
Yeah.
And I just thought I had to take advice because they were my investors. And that was because they didn't have a background in what they're doing. So that's a really essential thing, I think, particularly for early stage founders, where everyone will have an opinion on your business. Your ability to weight that advice and take it on accordingly is a really underrated skill.
No, I agree hugely there. I mean, we often say, there's lots of people out there, whether it's in the NED space where I am or in the investment space, in the consultancy space, we see them all the time. They may be highly skilled, they may be, but it's mainly theoretical. And find people around you. I always say use the word mentors. I don't mean, always just mentors, but find a group around you who've been there. I mean, this is one of the things when we started this podcast 3 years ago now, we spoke about the fact that we wanted people who'd actually walk that path, because otherwise we introduce yourself as a subject matter expert for that reason. It's people who are specialists in an area, but also they've been there before. We talk about the battle scars, and I think that matters. Something that I think you just said something really valuable as a takeaway there, which is understand that it can fail. Understand that on occasions they don't all go right, and any investor's not got a silver bullet or magic fairy dust, and they'll have experiences of when it fails and how to deal with it. I think is really important. What, in your experience, what are the top 3 reasons why a planned investment doesn't work out, both for the organization and for the investor?
Run out of money.
Okay.
That is number 1, 2, and 3. They run out of money. They run out of money to deliver on the plan that they've given. That is especially true after the funding boom that we're sort of dealing with the hangover of post-COVID. I think we invest at a tricky time, right? We invest in sort of a seed stage business where you're starting to take on proper costs, but you perhaps don't have real proper revenue yet, right? So you're investing prospectively based on the fact that you believe this thing can scale, and your decisions have to lay the ground for the future, but ultimately have to lead to revenue. And I think that other than running out of cash, not being able to be adaptable quick enough and cut your cloth accordingly, invest in the right things, and also if they're not working, cut them and invest in something else. Ultimately, at our stage, you're just forming lots of tests to see what sticks, right? So that kind of experimentation mentality, absolutely essential, because there's nothing better when a founder comes back to us and goes, we tried this, tried that, tried this. Those 2 didn't work, but this did. So we're doubling down on that and we're moving further with it. And so running out of money, that kind of experimentation route to revenue is ultimately the challenges. And I think finally, it's kind of, I think one of the transitions that's really difficult in startup is getting that initial team absolutely nailed. Because what tends to happen is you are a wobbly, unknown, entity. Yep. And you're trying to pitch the best people at the top of their game to quit a fairly well-paid job which has got stability and it's got a structure and it's got HR, and take a bet that you are going to make it work, right? What tends to happen is founders will feel more comfortable because they've had 300 in LinkedIn job applications, and they've scanned the market because they've gone through 300, despite the fact that, say, that 300 are rubbish, and they've just filled the roles with people who can do the job, not people who are exceptional.
Yeah.
And I think that, and that's okay, right? Because even the biggest startups in the world who never compromise on people, tech, infrastructure, at one point had to make shortcuts because money was in short supply and they hadn't made it yet, right? I think that transition from initial group of people who will do the job to world-class team is really difficult. And I think one that is made too late, and often
Totally.
people don't, they hire slowly, fire fast, right? And actually that transitional phase can be really difficult. But again, another really good example of actually where the team gets messed up is often when founders first fundraise, they'll hire big brand names or ex big brand names that will make them feel safe, right? They're a big global corporate blue chip, whatever. I'll get the head person from there who costs a bloody fortune to come in and fix my company or do my company, and silver bullet hire. What tends to happen is they've been insulated by process, structure, and a big brand. They've made a big brand bigger,
Yeah.
and they're amazing at that. But in a startup, if you can't figure out whose job it is, it's probably your job, right? They're not scrappy. They've probably not been on the tools. They're probably not that effective at getting things through at pace and quickly. And what tends to happen is they're a bit of a fish out of water. You waste a year because you wait for them for 6 months to see if they do anything, and then the 6 months later you're trying to get rid of them. All of a sudden you've lost a year's of funding on someone who's very expensive. So that initial cohort of people that you bring around you should be willing to go the distance for you and should be there for more than money, to be perfectly honest. As in, they should be there because they believe in what you're trying to do and treat it like it's their own business. And that initial team makeup is so difficult to nail.
I agree. We often talk, Ben, about understand the difference between startup and scale up for that reason. And the team that's got you so far is, in my experience, never going to the team that gets you to the next level. You can see behind me, I always bring sporting analogies into these things, and it's that classic thing, whichever sport you follow, when you go from that championship to Premier League or whatever, you have to change your squad, and it's that simple. I also think something you said there, which is really valuable consideration, is exactly in the same way that lots of clients will look for the logos, the valuable logo on their website. And I always say, be careful, logo soup, exactly that. They look for that big hire. And I've had experience of investors being really useful at that, helping that hire, because they know some of those people. They know very often the people who've done that specifically for a smaller business. And there often seems to be reticence from the founders that it goes back to the investors telling me who to hire. But it works both ways. If you've got a good investment partner, they're only interested in you getting the best people. But sometimes I've seen that sort of fracture. One thing I did want to ask you there, you spoke about, two things specifically about location. You said a couple of things there about the North. So how has the North startup ecosystem changed over the time since you've been in it?
So first things first, I think this is the best place to start a business in the UK at the moment. And therefore, if it's in the UK, it's in Europe. We are so well poised to keep on this trajectory that we're on, to build like amazing companies from here. When I first started some years ago now, it was pretty scrappy. There were some big mainstay brands here that household names, but the kind of startup ecosystem, everyone kind of knew each other, to be perfectly honest, in terms of it was a sort of quite a small group of people, to be perfectly honest. And I think that what's been really interesting, and that's been partially through really great public sector leadership as well as kind of private sector ambition, is Manchester and the Northwest generally, and Yorkshire actually, I think it's across the North, to be perfectly honest, has put itself on the map, basically. So whereas once it was sort of a small group all with a shared mission, actually this is now splintered out to real deep sector specialism, like our fintech industry is amazing across different parts. You're seeing real strides in things like AI as a technology in the Northwest as well. You're now seeing people stand up globally and look at the northern cities to create meaningful businesses. So if you look, Manchester saw the highest growth in equity deals post-COVID, percentage-wise, of any other city in the UK. Likewise, you've kind of seen these breakout success stories. Then the SLTs and all the senior people then go back and start their own companies. And actually that kind of cyclical effect is now in full swing. And what's great is it's sort of big enough to be globally ambitious, but small enough so that the community still roots for each other, which is a really lovely position to be in, right? Whereas I think in London, yes, there's obviously bigger clients there and more opportunity and whatnot, but actually it's a global city and there isn't necessarily as much kind of community cohesion, at least not unless you're in certain sectors. And also, likewise, I'm not here to London bash, right? It is great. We're 2 hours down the road. I mean, Christ, the train ticket's expensive. But other than that, it's great we've got such proximity to that, because we've got proximity to one of the world's mega cities, whilst actually, do you know what? Amazing knowledge assets, really flourishing labour market where you aren't paying crazy prices like you are in the south anymore.
Yeah.
And actually, it's transport wise, we're pretty well connected to lots of different things. So I think that you can tell the kind of health of an ecosystem at how many things like accelerators and different programs are popping up. And at the moment, it's absolutely non-stop in the north of England. And I think that there is a window of opportunity here where we need to keep on that trajectory and keep things moving in the right way, because we've had some great breakout success stories. But if you look at some of the Tech Nation reports, the idea is that we need to now back ourselves a little bit and compound on that growth effectively. So, we manage something called the Northern Powerhouse Investment Fund, which is basically trying to do just that effectively. So we'll invest anything from, say, 200k up to 5 million quid. But from my point of view, we need much more investors coming to this part of the world. And we're working with people like the Department of Trade to bring investors over from America so we can start getting fundraising from America coming over here. But I think what's interesting from our point of view is if you look at London and the North, both about 20% of GDP, about 20% of number of businesses based here. 80% of VC funding goes to the Southeast. 10% comes to the North. So it kind of just goes to show that we've got the capability and the ambition and the output. It's just about funneling more funds and us setting our sights a little bit higher and broader. And I think, as I said, you see some knockout names like, we back people like the Modern Milkman, who as part of the FT was the 8th fastest growing business in Europe. He's now expanded to America. There are some amazing businesses here who are a peer group that anyone would be proud of. And I think that it's just about recycling that talent and that kind of scale up experience through this ecosystem. But I'm incredibly positive about the future.
I think that one of the things you said there, the big difference is you say, I think it's a genuine ecosystem. My experience is, yes, there used to be, and I'm going back maybe 20 years, there's a belief that, if you wanted to find money, you had to go down to the city of London. I think that's changed, but I also think as part of that ecosystem, you said at the outset there, is I think the link between private and public, particularly in Manchester, the city of Manchester, is really beneficial, and something which I think collectively, private and public, we need to do more. Even conversations like this, Ben, we need to do more about getting all that out there, because people don't often understand that there is that genuine, we can call it tribalism, but there's that genuine belief and desire to see the small businesses grow into, as you say, more global pieces coming out of Manchester. Digital is the new cotton, as I keep trying to tell everyone, but they don't listen.
I couldn't agree more. Like people like GMCA, Bruntwood SciTech, British Business Bank, the West Yorkshire Combined Authority, the LCR guys, there is, what's lovely about this part of the world is if you start something and have genuine potential, there is a large number of people who want to get behind you and see that come to fruition.
So I suppose the final question really, Ben, is people who are listening to this have probably got an appetite, probably either wanting to look at what does investment look like, or they've even got a reason to do so. What would you, if I said to you, what would your advice be for someone looking to fundraise this year? What would it be?
Timing. I think timing is key. And there's twofold to this. One, start earlier than you think, right?
Yeah.
Get prepped, because life gets in the way. You've got day-to-day, you're running a business, day-to-day operations. I cannot stress to you, getting your data room in order, getting your pitch deck in order, getting your house in order will make the entire thing smoother. And you also don't know when an opportunity might come along.
Yeah.
The second thing is, when pitching to investors, what people always miss is why now. So the management team's great, the product's interesting, the traction makes sense, the plan makes sense, all good. Why now? Why is now the time for you to scale this business? Because that sense of urgency is really important to create that that propensity for the deal to be done. So I think timing is something that founders often get wrong. Start a year out from when you might want to be fundraising, right? That's when you start prepping. That's when you start calling. That's when you start building those relationships. And then finally, when you do get to that point, how do you keep momentum and how do you keep urgency, if you like, in the deal, using that kind of why now answer?
I'd just like to ask one question there on timing, or one not clarification. I often think, how do you reconcile timing? Because very often you hear good and bad stories. So this fund's a 3-year fund, and it's going to start and it's going to close. So we're only interested in companies that are going to exit in that time period, or is it a question of, hang on a minute, we've started this journey, and as we've gone along, the ambition of the investor and maybe the ambition of the founder or the investee becomes blurred? Where does the timing come, and how do you challenge that in what you need to get out of a deal and what the investee needs to get out of it?
So, great question. Each fund will have different exit timelines for the the duration of the fund. So you take our EIS, we say we are going to return investors' money between 4 to 8 years, or make the return within 4 to 8 years. So if we're investing today, in 2029 up to sort of 2033, we will be looking to exit during that period. Now, exit requires a buyer, a trade sale, or whatever that might be. So we don't have complete control over that, but those mandates are fairly set in stone, right? So if there is someone, which is quite unrealistic, but like if someone's looking to make a 2x return in 2 years, a bit of a red flag, because that doesn't tend to happen, to be perfectly honest. So those timelines and those exit timelines are, you need to make sure that the funder you have partnered with is on the same page as you.
Yes.
Some sectors, for example, like life sciences, take 10 years to exit, right? Because actually, you know what? They take far longer to build and blah, 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 blah. So it's just making sure that your alignment, when you're trying to do the deal and everyone's, really keen to get it done and there's energy behind it, just make sure before you take that money on that you are aligned in terms of what you expect the business to do in the next X years.
Alignment is the word I was looking for. Alignment is definitely the key. Valuable lesson. Thank you. Cheers, Ben. Thank you. Well, thank you to Ben for that informative and really interesting conversation around VC. I hope that's been of use to you. As always, I've been Stuart, and hopefully we'll see you once again back in the map room. Bye for now.